So what I want to
It's
talk about
perfect.
are the three different types of expenses that one may have in a multifamily investment on your P&L. So, and one of them is actually not on your P&L, really. So basically, everyone's pretty familiar with operating expenses and capital expenses, or CAPEX, OPEX and CAPEX, right? And the big distinction there, as people in the lingo know, say uh, above the line and below the line, right? And the line refers to NOI. So your typical profit and loss statement for a multifamily deal, or really pretty much any accounting statement, is going to be revenue, operating expenses, then you have net operating income. But that doesn't stop there, because then you have non-recurring expenses, one-time expenses, big expenses that don't really fit in your operating expenses, but are still real expenses incurred. And those don't go into your operating expenses. Therefore, they're not factored into your net operating income, and they go below the line, below NOI, which a lot of people refer to that as CAPEX, but technically speaking, it's actually not CAPEX. It's actually a replacement. So it's non-recurring. It's replacements, and so that is basically an expense on your P&L, but it's not in your operating expenses. It's more like one-time expenses, but you actually don't capitalize them. They're not a capital expense, because a capital expense, something that you capitalize, technically goes onto your balance sheet and is reflected as an asset. So, like, for example, if you were to replace the roofs and spend $1 million on all brand new roofs for your property, that's an you could capitalize that expense, and it's a capital expense, a CAPEX, and that could go on your balance sheet. So you actually spent $1 million on new roofs, and so that CAPEX actually goes on your balance sheet as an asset. It's an asset, right? That it goes towards increasing the value of the property. So trying to remember kind of what, like, the nuance that I wanted to share, but it's just interesting to think about. You've got these three different buckets of expenses, and there's not necessarily hard and fast rules as far as what goes where. It's kind of a judgment call, and so actually one thing that comes to mind is one of our investors is asking about DSCR, and they're saying, well, what's the DSCR of this property right now, of this investment? And so DSCR, we've talked about many times on the show. It's your debt service coverage ratio. So the simple math on DSCR calculation is just your net operating income divided by your debt service, which your debt service is basically usually your principal and your interest payment, right? Whatever the cost is to actually service your debt. So if you have a property with $125,000 of net operating income, and in that same period you have $100,000 of debt service to pay your lender for that month, your debt service coverage ratio is 1.25. Now, that is a great metric, and it's helpful, and it's I love it. DSCR is great. The problem is, what if at my discretion and my accounting team's discretion, we have a ton of expenses in this period, and we say, no, 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 those appliances and that HVAC repair and this waste removal, this pest control, whatever, all these expenses, those aren't operating expenses. Those are actually replacements, and those go below the line, so they don't factor into my NOI. So now my NOI, instead of being 125,000, is 150,000, or better yet, it's 200,000 of NOI, because I'm choosing. I'm not necessarily not saying this is illegal, not saying I'm being fraudulent, but those expenses I decided are non-recurring, and I put them down below the line in my replacements. So now my DSCR is 2.0x, and that's a eye-watering DSCR. Like, anyone would be like, wow, that's an amazing DSCR. The
You're
property's
printing
performing
cash.
so well.
Yeah.
Yeah, like, you've got so much cushion, everything's great. So, and I'm
You
not trying
actually,
to.
if you have a 200 DSCR, you need to refi some cash out.
Yeah, exactly.
You
Like,
need
you're
to pull
doing
money
too
out.
well.
Yeah.
You need to have more debt
Yeah.
on the property. Yeah.
Yeah.
So
You need to grow your money elsewhere.
I'm not trying to invalidate the DSCR metric, but it's just, whenever you zero in on one thing, you're obviously not going to see the full picture. So it's just so hard, because everyone wants things to be simplified and just easily answered. And it's actually so funny, because I was actually with
What
a.
also if your DSCR is there, you're probably just levering your property up artificially higher, right? Especially on an acquisition of it,
Where you're saying, well,
or you're
the two,
delevering it. Sorry.
yeah, exactly. Like a 2.0 DSCR would imply, wow, you're under levered. I mean, some people
Yeah.
maybe want to run a 2.0 DSCR, but for real estate, depending on the real estate, for multifamily, it's very normal and acceptable, and lenders underwrite to a 1.25 DSCR because multifamily is a stable performing asset class, so you can actually lever up. Now, if we're talking like an oil and gas investment, or if we're talking about if we're talking about multifamily in Midland, Odessa, which is out in West Texas, where they pump oil, drill for oil, right? Fannie and Freddie, they won't do a 1.25 DSCR. They'll size it to a minimum of 1.5 because it's a boom bust oil town. Like, you're not investing in multi at that point, you're investing in oil. So the lender has a completely different risk metric when it comes to those lending parameters. So yeah, I mean, the point is, with these different expenses and accounting, like, accounting is so complicated, and it's so hard to just look at one thing to determine if the property is performing well. For example, today I was with an investor and we were looking at some of our properties that we own together, and I'm not saying this is wrong or that they did anything wrong, but every no matter how savvy an investor is, and I do this too, the first thing, let me ask you, what's the first thing you want to know about a property if you're just trying to checking in on it?
The first thing I would want to know about a property if I was checking in, a new investment or a current investment?
Current investment, how's it doing?
How's occupancy?
Exactly. Everyone wants to know what occupancy is, right? And I don't blame them, and I do too. It's just like such a tangible thing. We want to understand how many heads in beds, right? The
Well,
problem with
also, it not only is it a tangible thing, but it also reflects upon, okay, is this management team asleep at the wheel? And that doesn't mean that you've got good tenants in there, which we can get into something like that later. It doesn't mean you have good tenants, but at least they're doing something. The property is at least attractive. You chose an attractive wife here. You chose a property that people want to live in for the price in a very fluid market.
Well, there you go. You mentioned so many things that can go wrong with just drilling in on occupancy, because maybe the occupancy is high because the rents are too low. Maybe occupancy is high because the on-site team is derelict in their responsibility of evicting, and they're just keeping non-paying tenants hanging around, even though they're completely useless. Like, I preach to my team all the time, let it be vacant. I would rather have a unit be vacant than be filled with someone who is not a good neighbor. Like, we just don't need those people. So that's why we need to screen hard, and we need to make sure that we're only bringing in new residents who are going to add to the community and who are going to pay their rent consistently on time. So occupancy is a vanity metric. Like, you can walk in and say, oh, well, the occupancy is 95. It's like, well, like, what does that mean? Because what if 10% of that occupancy is non-paying tenants, and what if rents are too low, and so on and so forth. So again, I'm not bashing occupancy, and I'm not bashing anyone who thinks occupancy is important. Occupancy is important, but the funny thing is, it's not the tell all. And if I were to kind of zero in on a tell all, I would actually zero in on collections. And collections is basically, it doesn't get any more simple than cash in the bank. How much cash did you collect for this month? And so, in addition to occupancy, that's something that we are fixated on, and we're actually rolling out as we speak a new bonus program that the entire property team participates in. So the maintenance guys, the leasing agent, assistant manager, the manager, everyone
So
participates in this
everyone's
team bonus.
incentivized to do the best and have good service. So it's an all or nothing. Very interesting.
Yeah, so let me share more. It's so cool. I love it
That's
because
I actually didn't know this. This is fresh news. I guess maybe I shouldn't miss out on town hall meetings.
no, I'm just too busy doing, and I'm not sharing. So
Yeah.
so with this bonus, like, the maintenance guys, they understand intuitively that I need to get units ready for move-in, because the more move-ins we have, the more collections we get, right? And so the way that this bonus program works is the on-site team collects a bonus for every occupied unit that doesn't have a balance. So it does that unit, I don't count occupancy where they owe rent, right? So at the end of the month, we see how many units are paid up. We call them paid up units, PUUs. So we are looking for maximizing PUUs, because that's what I really want. I want to see the property fully
So
occupied.
paid. You're saying it. You're saying it very quick. So paid up unit. Not PEU, not PED, PUU. Just so we're crystal
Exactly.
clear. We're
Yeah,
going
it's very
fast here.
similar.
We're getting a master's degree here, okay? And
In 2 minutes.
we need to break down this concept nice and smoothly.
Yes, agreed. Not a performance enhancing drug, not a PED, but a PUU. And the way that we do this is, here's the thing. Not even properties, investors make money with that final amount of cash flow, right? So investors really make money not on the occupancy from 80 to 90. They make money from the occupancy being 90 to 95, 96, 97. For every point of occupancy that's paying above 95%, that is super meaningful because it's like almost all profit, right? Because there's a lot of fixed costs associated with multifamily. You have property taxes, you have insurance, you have the debt service. There's a lot of fixed costs, and payroll is largely a fixed cost. So the majority of your costs are fixed, and what that means is when you can squeeze out that marginal dollar of revenue, that's hitting the investor bottom line, and that's making the cash flow go up.